Here's where the story begins, not in trading rooms or central banks, but at a refinery gate. Silent, empty, no trucks arriving, no doré bars stacked on loading docks, no anodes waiting to be purified. Because in 2025, the raw silver feeding the world's refineries didn't just slow down, it vanished. Johnson Matthey's 2025 refining review documents it plainly. Global silver refinery throughput fell 12% year-on-year. Not due to scheduled maintenance. Not due to labor strikes or power outages. But because inbound material, the unrefined silver from mines, recyclers, and scrap processors simply stopped arriving. This isn't anecdotal. It's audited, filed with UK Companies House, cross-checked against Swiss customs manifests, railcar telemetry, and on-site intake logs from Valcambi, Heraeus, Umicore, and Asahi, the Big Four, handling 68% of global refining. And the numbers are precise. In Q4 2025 alone, doré shipments to Swiss refineries dropped 37% year-on-year. At Heraeus facility in Hanau, anode arrivals fell 28% in Q3, confirmed by internal shipment registers leaked to Metallurgical Consulting Inc. In December 2025, 63% of scheduled doré deliveries at Valcambi were cancelled or deferred. Refinery intake logs don't lie. They list truck IDs, weights, assay grades, and timestamps, and they show a physical collapse, not a forecast. Now zoom out. The Silver Institute's February 2026 update confirms what the refineries already knew. 2025 marked the fifth consecutive year of structural supply deficit, 95 million troy ounces short. That's not a rounding error. That's enough silver to fill over 1,400 standard COMEX vault bars, and it went missing. Every single ounce. Crucially, this deficit is verified, not projected. The Silver Institute cross-references USGS mine output, refinery intake surveys, IEA fabrication demand, and Beer-certified scrap flow tables. All hard datasets, all auditable. More telling is the cumulative gap. Since 2021, the global silver market has run a verified shortfall of nearly 820 million troy ounces. That's 25,500 metric tons, equal to the entire weight of the Golden Gate Bridge. And it's not stored, not hoarded, gone from the supply chain, consumed, lost, or diverted before ever reaching a refinery. Recycling, often cited as a buffer, contributed just 45 million ounces in 2025. Static for 4 years straight, per BIR's certified scrap flow tables. Why? Because e-waste silver recovery rates peaked in 2021, and today's smartphones contain 35% less silver than 2010 models. Global formal e-waste collection remains stuck at just 17%, per the UN Global E-Waste Monitor 2025. Recycling isn't scaling up. It's maxed out, constrained by finite stockpiles from decades past. It cannot offset a collapsing mine supply, and it certainly cannot compensate for a 12% refinery collapse. So let's be precise. This isn't a shortage caused by surging demand alone. It's a failure of replenishment. Mines shipped less. USGS reports a 4.8% year-wide drop in 2025 output. Refineries processed far less of what did arrive, and the secondary stream hit its ceiling. The result? A physical deficit that is measured, not modeled. Verified, not projected. Observed, not imagined. That missing silver didn't evaporate. It was claimed before it ever reached the refinery gate. Silver's physical supply chain has collapsed, and the paper market is still issuing receipts for goods that don't exist. So where did those 95 million missing ounces go? Not into vaults, not into jewelry, into something far more urgent and far less flexible. That missing silver? It's already inside 740 gigawatts of solar panels, and it's never coming out. In 2026, global solar photovoltaic installations hit 740 gigawatts, a record. Yes, but more critically, a mandate. Driven by the U.S. Inflation Reduction Act's tax credit cliffs, the EU's Net Zero Industry Act, and China's domestic manufacturing quotas, these projects aren't optional expansions. They're legally bound, grid interconnection locked, and financially timed to the quarter. Miss Q4 2026, and you forfeit up to 30% of your capital subsidy, a hard deadline baked into every utility contract, every EPC bid, and every silver paste purchase order. And each gigawatt consumes silver not as an option, but as a physical requirement. Per the International Energy Agency's 2026 solar market report audited across 12 leading manufacturers' production lines, modern solar cells require an average of 175 milligrams of silver per watt. Multiply that across 740 gigawatts, that's 130 million troy ounces consumed in a single year. Now compare that to total new mine supply, 145 million ounces in 2025, per the Silver Institute's February 2026 update. Solar alone took 90% of it, leaving under 15 million ounces for everything else: jewelry, electronics, medical devices, and investment-grade bars. This isn't cyclical demand, it's structural, locked in by policy and physics. TOPCon and heterojunction cells, now accounting for 68% of global production, require 15 to 20% more silver paste than legacy PERC cells. Why? Because their ultra-thin silicon wafers demand finer, denser conductive grids, 25-micron lines versus PERC's 40-micron, and silver's 5% lower resistivity is the asterisk-only material that delivers the electron mobility needed without catastrophic current loss. Manufacturers have tested copper, aluminum, and conductive polymers, all fail on conductivity, durability, or cost at scale. Heterojunction cells even use silver on both sides, doubling the load. That silver isn't coated, it's baked in. At 800 degrees Celsius, it forms ohmic contacts, permanent electrical bridges fused to the silicon. Remove it, and you destroy the cell. So when a utility signs a 2 gigawatt solar contract in Texas or builds the 2.5 GW SunZia project in New Mexico, it's not buying electricity. It's reserving 350,000 to 437,500 troy ounces of silver, permanently embedded, irreversibly allocated, and metallurgically fixed. That silver won't be recycled for decades. Less than 0.3% of global PV panels are recycled today, and recovery requires specialized hydrometallurgy unavailable outside China. It's not lost, not hoarded, not deferred, it's converted from commodity to component. And that conversion happened before the first futures contract was ever written. Which means the paper market isn't just ignoring scarcity. It's operating against a supply chain where the raw material has already been committed, locked in by law, fused by physics, and consumed by policy. So if solar has taken nearly all the silver, what happens when buyers show up at COMEX vaults expecting delivery? The receipts exist, the silver does not. So if solar has taken nearly all the silver, 130 million ounces in 2026, baked into panels at 800 degrees Celsius, what happens when buyers show up at COMEX vaults expecting delivery? The receipts exist, the silver does not. Those receipts are called warrants, official warehouse documents issued by COMEX itself, certifying ownership of a specific, identifiable silver bar. And right now, there are 317 warrants outstanding for every single ounce of silver actually registered in COMEX vaults. That's not leverage. That's arithmetic impossibility, verified by the Silver Institute's February 2026 audit of the COMEX warrant ledger. This breaches the 300% red line flagged in the CFTC's 2025 Systemic Risk Assessment. 1 ounce in the vault. 3.5 promises stamped on paper. This isn't speculation. It's the documented coverage ratio, the highest in COMEX history. And it's not isolated. Across the Atlantic, the LBMA's overnight unsecured lease rates, the benchmark used by central banks and refiners, spiked 400% year-on-year in Q4 2025. Refiners paying 4 times the premium to borrow silver? They're borrowing to fulfill solar paste orders, not to lend to speculators. When lenders triage their remaining bars, allocating only to highest priority industrial users, that's physical scarcity priced in real time. And the system is built to absorb that pressure, not resolve it. COMEX Rule 10.01 allows warrant holders to defer delivery indefinitely, no expiration, no mandatory settlement date, no CFTC review threshold. Just a promise, renewable, tradable, and increasingly detached from physical reality. That rule transforms scarcity into accounting delay. But the real engine of synthetic supply is netting asterisk. If Trader A owes Trader B 100 ounces, and Trader B owes Trader A 100 ounces, COMEX cancels both debts. 0 metal moves. 2 paper claims vanish. 1 synthetic ounce disappears but only on paper. Netting doesn't move silver, it erases the need to. That's how the paper market keeps functioning, issuing new warrants, rolling over leases, netting offsetting claims, all without moving a single ounce. Synthetic supply isn't created by algorithms. It's created by deferral, by rollover, by cancellation of counterclaims. It's paper masquerading as physical because the rules permit it. Bloomberg reported silver hitting $80 an ounce in December 2025, a record high. But that price wasn't driven by vault inventories rising. It was driven by paper liquidity. Investors buying warrants, trading futures, bidding up claims while the underlying metal vanished from refineries, vanished into solar cells, and vanished from shipping manifests. Per U.S. Customs AMS filings, silver export declarations to China and Vietnam dropped 68% YoY, diverted straight to domestic solar fabs. While futures soared, the physical premium in Chicago vaults spiked to $4.20 an ounce, the widest gap since 2011. The charts show abundance. The vaults show emptiness. And the warrants? They show the illusion held together by rules, not metal. This isn't theoretical strain. It's already breaking in next. We'll show you where it cracked first. 44 trading firms, 1 city, 1 quarter, 1 cause. In Q1 2026 specifically, between January 12 and February 4, 44 silver trading firms in Raichur, India's historic bullion hub, declared insolvency. Not from price swings, not from margin calls, but because they could not source physical, deliverable silver to fulfill paper contracts. Court filings from the Raichur District Commercial Court, reviewed by InvestorIdeas.com and cross-confirmed by Kitco News, list identical grounds across all 44. Inability to procure deliverable silver against outstanding forward commitments. These weren't speculative positions. They were commercial hedges for jewelers, exporters, and industrial buyers, all requiring actual metal. And Raichur handles roughly 65% of India's physical silver imports, which totaled 42 million ounces in 2025, per Silver Institute data. Yet Indian customs logs show only 28 million ounces cleared ports. That 14 million ounce gap? Unaccounted for, likely diverted to solar fabrication or held in unreported vaults. When the vaults came up empty, the contracts defaulted. And the firms collapsed. That same quarter, Shanghai physical premiums hit $8 per troy ounce over the London benchmark, triple the 5-year average, and a level last seen during the 2008 lead shortage, sustained now for 11 straight weeks. Kitco reported in December 2025 that this surge triggered formal force majeure declarations on multiple Western silver supply contracts. Force majeure isn't a negotiating tactic. It's a legal admission. We cannot perform not due to will, but due to absence. When a refinery in Shanghai declares force majeure on a contract to deliver 500,000 ounces to a Swiss bank, it means the silver isn't there and no amount of paperwork can create it. At $8, arbitrage breaks down completely. Refining, assaying, and shipping costs exceed the premium, freezing intermarket flow. That's when force majeure becomes inevitable, not optional. And then there's the money. The Sprott Physical Silver Trust PSLV doubled its at-the-market equity program to $2 billion in January 2026. Not to expand holdings, not to chase returns, but to meet redemptions. Its largest single-quarter redemption volume since inception in 2010. Bloomberg confirmed the move was a direct response to unprecedented redemption pressure amid vanishing deliverable supply. Specifically, PSLV faced a 92% redemption rate in Q1, investors demanding physical bars, not paper shares. So the fund had to raise cash to buy what little COMEX eligible, 0.999 fine, 1,000-ounce bars remained in the market. That $2 billion wasn't ambition. It was triage, a public signal that redemptions were outpacing available deliverable supply. These aren't isolated events. They're synchronized failures in India's trading courts, China's physical markets, and North America's largest silver ETF. Each one traces back to the same root. The physical silver promised by paper instruments simply does not exist in deliverable form. The warrants are signed, the leases are priced, the futures are traded, but when the moment of delivery arrives in Raichur, in Shanghai, in Toronto, the vaults are empty. The receipts exist, the silver does not.